ASML is single-handedly shaping the future of global technology. Without its cutting-edge lithography machines, there would be no next-generation chips in our smartphones or supercomputers, and no generative AI revolution. ASML stock, listed in Amsterdam, has quite literally doubled in a year, rising 109% over the past 12 months to reach a record €1,319.40 on May 8, 2026. With a market capitalization now above €500 billion, ASML has become Europe's largest technology company, supported by the aura of a near monopoly. The stock, valued at nearly 50 times annual earnings, is being driven by excitement around AI-related semiconductors. So the key question is simple. Is this spectacular rise backed by solid fundamentals or by euphoria? Let's start with a quick introduction to ASML. Based in the Netherlands, the company was founded in 1984 and is an indispensable link in the semiconductor supply chain. ASML does not manufacture chips. It supplies the equipment used to produce them at scale, especially lithography machines. This process uses light to etch tiny circuits onto silicon wafers, quite literally turning sand into microprocessors. ASML dominates this niche. It controls 100% of the global market for EUV lithography machines, extreme ultraviolet lithography, and nearly 95% of the overall lithography market, including the older DUV generation. In other words, without ASML, the world cannot manufacture the most advanced chips. It is the essential gateway for any foundry that wants to produce leading-edge technologies below 7 nanometers. Its EUV machines are enormous systems, roughly the size of a bus, weighing more than 180 tons, and made up of over 100,000 parts supplied by around 5,000 subcontractors. Building one of these technological giants requires years of R&D and extraordinarily precise assembly. Its German partner Zeiss, for example, supplies mirrors polished at the atomic scale. Each EUV system sells for more than €150 million, and the newest generation can reach €400 million. Thanks to this unique business model, ASML benefits from captive demand from nearly every major chipmaker. With almost no direct competition in its segment, ASML mainly serves the three semiconductor giants, TSMC, Samsung, and Intel. Today, ASML is essentially selling the picks and shovels of the digital gold rush. Its business is divided into two main segments, the sale of new lithography machines and services for its installed base. The second segment generated more than €8 billion in revenue in 2025, up 26% year-over-year, reflecting both a growing installed base and long-term customer relationships. The company's main growth drivers include the rollout of high-NA lithography, high numerical aperture lithography, which is expected to enable chips of less than 2 nanometers between 2028 and 2030, as well as the continuing rise of AI and data processing. ASML is therefore riding several structural trends at once: the extreme miniaturization of chips, the chronic shortage of manufacturing capacity in the face of surging silicon demand, and the determination of major powers to strengthen their semiconductor infrastructure in the name of technological sovereignty. So why is ASML so dominant? The answer lies in its extraordinary moat. First, its intangible assets. The company holds thousands of patents in EUV lithography, the result of 30 years of R&D costing more than $10 billion. To understand why that matters, you have to look under the hood of the technology. No one else has mastered EUV at this level. After 2 decades of effort, ASML solved a near impossible scientific challenge, generating a stable beam of extreme ultraviolet light and using it to etch patterns measured in just a few nanometers onto silicon. The sheer complexity of this process gives ASML an almost insurmountable barrier to entry. Even with more than $100 million in funding, one American startup is still only at the stage of producing rough copies of the technology, while reported reverse engineering efforts in China run into one basic problem. There are no EUV machines on Chinese soil. On top of that, ASML benefits from network effects and extremely high switching costs. Its customers, now dependent on its know-how and its unique supplier network, have no viable alternative when equipping their fabs. As a result, the company enjoys a global quasi-monopoly that it protects very effectively. Christophe Fouquet, the CEO, recently said he is confident that no one will come and dethrone them, given the company's decades-long technological lead and ecosystem of exclusive suppliers. Even so, a champion this strong is not invulnerable. Let's look at the 3 main risks that could cool some of the enthusiasm. First, the unavoidable cyclicality of the sector. Many investors seem to forget this, but the chip industry is cyclical by nature, and equipment makers like ASML are on the front line when the cycle turns down. Today, the surge in spending on generative AI is creating overheating. Orders are soaring, and ASML itself has acknowledged that chip demand currently exceeds supply. That is very favorable for its record order backlog and for its upgraded financial guidance. ASML has raised its outlook and now expects 36 billion euros to 40 billion euros in sales in 2026. But overheating can be dangerous. This supercycle could eventually reverse. If the current rush to expand production capacity leads to an oversupply of chips within 2 to 3 years, customer investment could contract sharply, just as it did in 2019, when the memory cycle turned and temporarily dragged down ASML's sales. Second, ASML cannot escape geopolitical tensions. Export restrictions imposed by the United States on China are already expected to reduce ASML's sales in China from 33% of revenue in 2025 to roughly 20% in 2026. This lost revenue is a direct headwind worth several billion euros per year, and it could worsen if Beijing develops credible alternatives of its own. ASML has also had to commit to no longer selling its EUV machines to China in order to avoid clashing with Washington, which gives the company's growth outlook a distinctly political dimension. On top of that, the global macroeconomic environment can deteriorate quickly. The escalation of the conflict in the Middle East creates a risk for the Strait of Hormuz, a route that is crucial for the energy supplies of both Asia and Europe. A spike in oil prices would reignite inflation. Central banks could then tighten credit too aggressively, raising the cost of capital and putting pressure on technology valuations, including ASML's. Finally, logistics costs and the prices of certain strategic raw materials could rise again, weighing on supply chains. In short, ASML is performing strongly, but like any global leader, it remains exposed to international uncertainty. Now let's turn to the stock chart. It shows one of the most impressive runs in the European technology sector in recent years. The share price was around 416 euros in May 2021, and by May 8, 2026, it had reached a record high of 1,319 euros, more than tripling in 5 years. We can break that move into 3 phases. First came the turbulence of 2022, when interest rates were rising sharply. Then, very quickly, the artificial intelligence revolution took over, putting ASML in an almost unmatched position. Finally, the 2025 to 2026 period suggests that the group succeeded in its technological bet on the new High-NA generation, despite geopolitical tensions with China. Even so, ASML's current fundamentals are among the strongest in the sector. To assess the company's financial strength, let's focus on 4 key indicators. First, the spread between ROIC, return on invested capital, and WACC, the cost of capital. WACC represents the minimum return expected by investors, and when the gap is positive, the company creates value. It generates more cash than its capital costs. At ASML, the latest figures suggest a ROIC of around 30% for 2025, well above an estimated WACC of around 8%. That means the spread is strongly positive, at roughly 20 percentage points, which is excellent. The second indicator is dividends. ASML rewards its shareholders with a payout that is rising steadily. The total distribution for 2025 was 7.50 euros per share, up 17% from 2024. The current yield is modest, at around 0.6%, because the share price has risen faster than the dividend itself. But that upward trend, combined with the share buyback policy, signals management's confidence in future cash flows. In practical terms, ASML offers more of a growth profile through share price appreciation than a passive income profile. Its dividends are more of a symbolic bonus, even though they continue to grow. The third indicator is solvency. ASML's debt is clearly below the sector's usual prudential thresholds. Net debt remains almost negligible, and the company holds more than 8.3 billion euros in cash, giving it an exemplary balance sheet that allows it to fund R&D, investment, and dividends without relying on debt markets. The final indicator is structural growth. ASML has delivered impressive growth in its results over the years, despite cyclical ups and downs. Its net profit more than tripled between 2019 and 2025, which implies a compound annual growth rate of roughly 20% to 25% over 5 years. Even after adjusting for exceptional items, that is remarkable for a company that is already mature. This dynamic shows ASML's ability to grow profits faster than revenue, thanks to technological upgrading and gains in efficiency. ASML is clearly both highly profitable and growing strongly. According to our positioning framework, it is an exemplary value creator, combining profitability and rapid expansion. Given these fundamentals, how should we assess ASML's current valuation in relation to earnings? Based on trailing 12-month earnings, the PE ratio is around 50 times, which is very high. Based on expected earnings over the next 12 months, according to analyst consensus, the forward PE is closer to 40. The gap between these two multiples points to strong expected earnings acceleration. In simple terms, if the forward PE is much lower than the trailing PE, it means the market expects profits to grow quickly, which helps justify a higher share price today. That is the case here, though not to an extreme degree, because 40 times earnings is still far from cheap. Historically, ASML has often deserved a quality premium. Its average multiple over the past 5 years was around 40 times. Today, the stock is trading above its own average, suggesting a double premium. Quality plus AI enthusiasm. By comparison, other equipment makers such as Applied Materials and Lam Research are trading at around 30 to 40 times earnings in 2026, also supported by the AI cycle. But ASML still sits at the top of the group thanks to its quasi-monopoly and its unique growth prospects. In short, based on earnings multiples, ASML looks relatively expensive, even if that remains consistent with its status as an essential industry leader. Let's now move to a fundamental DCF approach, an intrinsic valuation method that complements the view provided by multiples. ASML clearly belongs in the category of high-growth companies, which justifies a two-phase model. Over the next 5 years, we use consensus forecasts for FCF and EPS growth together with ASML's latest official guidance. Cash flows are expected to grow by 15% to 20% per year from 2026 to 2030, driven by the AI wave and the expansion of the semiconductor market. ASML itself is targeting 44 billion euros to 60 billion euros in revenue by 2030, which implies annual growth of 9% to 13% from 2025 to 2030. We then assume a gradual slowdown toward a moderate perpetual growth rate of 2% to 3%. Finally, we test two variants that reflect different market environments: a more cautious scenario, with a WACC of 9% and a TGR of 2%, and a more optimistic scenario, with a WACC of 8% and a TGR of 3%. These assumptions are designed to capture a range of financial conditions, for example, a higher rate environment, or, conversely, a lower risk one. Without going into the mathematical details, the key point is that a WACC of around 8% to 9% is consistent with ASML's cost of capital, while the selected TGRs reflect moderate long-term growth in a maturing technology sector. Our DCF valuation range is wide, as is often the case with growth stocks. The cautious scenario suggests a fair value of around 1,000 euros per share, while the optimistic scenario points to around 1,350 euros. This 35% gap clearly shows how sensitive the valuation is to future growth assumptions. To establish a reference point, we weight these two cases and arrive at an average estimate of about 1,150 euros per share as fair value, before applying any margin of safety. Given ASML's wide moat, we apply a reasonable margin of safety of 10%. That leads to a maximum buy price of around 1050 euros, rounded for clarity, which represents our cautious threshold for considering the stock undervalued. The cautious DCF outcome sits clearly below the market price, which suggests that the market has already priced in a significant amount of optimism that our cautious scenario does not fully capture. Since the current price of 1,319 euros already reflects something close to the optimistic scenario, we can infer that the market is pricing in the most favorable growth path, with very little margin of safety. Even so, by comparing the DCF with the multiples, we can still conclude that ASML is trading close to its high-end intrinsic value or slightly above it, given its quality. At this stage, the stock appears fairly valued, or perhaps a little expensive, which encourages a disciplined investor to wait for a correction. The next step is to translate that valuation view into concrete targets across different time horizons. Let's now set price targets over 1, 3, and 5 years under 3 scenarios: bearish, base, and bullish, and estimate the corresponding annual returns. In the bearish scenario, we assume the environment turns negative because of an industry downturn or a geopolitical shock that is more severe than expected. An investor who buys at our maximum buy price of 1,050 euros would limit the downside. In the bullish scenario, we assume that ASML outperforms expectations, driven by even faster adoption of high-NA technologies and by sustained AI-driven demand with no cyclical slowdown. This scenario reflects a near-perfect alignment of the stars: durable double-digit growth year after year, faster than expected mass adoption, and a valuation that remains elevated. In the base scenario, which we see as the most likely and broadly in line with current consensus, our one-year target is around 1,500 euros, reflecting a continuation of the current positive momentum. At 3 years, if ASML delivers the expected growth in cash flow and its multiples normalize, the stock could be worth around 2,000 euros, which would represent roughly 25% per year from our buy price of 1,050 euros. And at 5 years, we estimate a central target of around €2,500. From the current price, that would still represent a solid, though not extraordinary return. As a conclusion, ASML emerges from this analysis as a technology champion with strong finances, exceptional profitability, solid growth despite industry cycles, and a flawless balance sheet. However, the numbers also show that the current share price already reflects a large part of those strengths and of the company's future potential. The stock is not cheap. Based on our weighted intrinsic fair value of around €1,150, the stock appears slightly overvalued, or at best fairly valued, near the upper end of what can be justified by future cash flows. That is why we recommend applying a margin of safety and setting a maximum buy price at €1,050 to account for uncertainty. At the current price of €1,319, the expected annual return over 5 years in our base scenario is only about 14% per year. But by being patient and buying closer to €1,050, that return would rise to 19% per year, showing the power of discipline and long-term investing. Put simply, ASML is an excellent company, but not a bargain at the current price. Thank you for listening to this episode of Stock Lab. If you enjoyed this analysis, feel free to like the episode, leave a comment, and share it with others. Subscribe to our channel so you do not miss the next analysis. And above all, remember this. This content is provided for informational purposes only and does not constitute financial advice. Some analyses may rely on artificial intelligence tools, and their accuracy cannot be guaranteed. Always do your own research before making any financial decision.